Oil markets have always been unpredictable, but what just happened may be one of the boldest moves in years. OPEC, the powerful oil cartel led by Saudi Arabia and joined by Russia, has shaken the energy world with a sudden decision that caught Washington off guard. For decades, the United States believed it had wrestled control of oil markets through its shale revolution. But now that dominance is being tested. Some experts are calling this the start of an American oil collapse. Others insist it's just another normal cycle in a market famous for its ups and downs. The truth? It's not that simple. Because behind OPEC's move lies a much deeper story about economics, politics, and the future of energy itself. So the real question is this: did OPEC just knock America off its oil throne, or are we witnessing nothing more than another short-lived storm? In this video, we're going to break it down. We'll look at the moves OPEC has made, what it means for U.S. shale oil, how electric vehicles and renewables are rewriting the rules, and why this battle goes far beyond prices at the pump. By the end, you'll see why this moment could define the next chapter in global energy. Before we dive deeper, let's lay out exactly what OPEC did. Oil markets move on details, and the timeline tells the story. For much of 2024, OPEC and its allies, often called OPEC Plus, followed a simple playbook: cut production to keep prices high. Every time supply was tightened, Brent crude, the global benchmark, got a boost. That strategy worked for a while, but in early 2025, the game changed. On March 3rd, OPEC Plus announced that starting in April, they would increase daily oil production by about 138,000 barrels. That may sound like a small number in a world that consumes nearly 100 million barrels per day, but it was a shock because it marked their first production increase since 2022. Here's why this matters. 1 month they're cutting, the next they're raising. It looks inconsistent, but it's actually strategic. By pulling back when prices fall and adding supply when they want to stabilize the market, OPEC is sending a clear message. They still hold the steering wheel of global oil. Meanwhile, Brent crude prices slid by around $1.83 per barrel, or roughly 2.5%, at the start of 2025. That may not sound dramatic, but when you multiply it across millions of barrels sold every day, it means billions of dollars in lost revenue for producers. OPEC's April move is their way of adjusting the balance sheet. In short, these moves aren't random, they're signals. And every signal reshapes how the U.S. shale industry, financial markets, and even national governments respond. To understand why OPEC's moves hit so hard, we need to look at America's shale oil industry, because it's both the country's biggest strength and its weakest link. Shale oil, unlocked through fracking and horizontal drilling, turned the United States into the world's top crude producer. In December 2024, output hit a record 13.49 million barrels per day. That's a staggering number, honestly, one that gave Washington confidence it could stand toe-to-toe with OPEC. But here's the catch. Shale is expensive. Unlike Saudi oil fields, where crude gushes out of the ground cheaply, shale wells decline quickly and require constant new drilling. Think of it like a treadmill. You can't stop running, or production drops fast. That means costs pile up. On paper, high oil prices should help U.S. producers, but in reality, many are squeezed. Banks are pulling back loans because of ESG rules, investors want greener portfolios, and drilling costs keep climbing. Smaller operators are struggling to survive. Some analysts even say parts of shale are becoming unprofitable. Yet don't write shale off just yet. The industry is innovative. With new drilling tech, automation, and smarter wells, U.S. producers can cut costs when they have to. And giants like ExxonMobil and Chevron are not retreating. They're diversifying, putting money into carbon capture, hydrogen, and biofuels. In other words, shale isn't collapsing, it's adapting. The question is, can that adaptation happen fast enough? Because while U.S. producers fight to stay competitive, another force is already reshaping the demand side of oil. Even if U.S. shale keeps drilling, the bigger problem may be on the demand side. Oil's dominance is being challenged in ways we haven't seen before. Take electric vehicles. In 2025 alone, global EV sales are expected to jump by 18%, crossing 20 million units worldwide. That's not a niche anymore. It's a tidal wave. Every EV that rolls off the lot means one less car filling up at the pump. Multiply that over years, and the impact on gasoline demand becomes massive. And it's not just cars. Solar and wind power are eating into oil's role in electricity generation, while climate policies around the world are tightening the screws on fossil fuels. In the United States, the Biden administration has tied energy strategy to carbon reduction, pushing renewables and stricter emissions rules. Still, oil isn't disappearing overnight. Planes, ships, petrochemical plants, and heavy industries still run mostly on crude. Even if EVs cut into demand for cars, oil remains locked into other sectors. That's why experts say we're not looking at a sudden collapse, but more of a slow leak in demand. The shift, however, is enough to rattle producers. If OPEC raises prices too high, it makes electric vehicles and renewables look even more attractive, speeding up the transition. If they cut too low, revenues dry up. It's a delicate balancing act, and one that directly collides with the United States' ambitions to stay the top exporter. And that brings us to the next layer of the story, because behind these economic moves lies a geopolitical game that could reshape alliances and power balances. Oil has never been just about energy. It's also about power. And OPEC's latest moves aren't simply market adjustments. They're signals to Washington and the world. Saudi Arabia, the cartel's heavyweight, is playing a double game. On one hand, it needs oil revenues to fund its Vision 2030 plan, which is, a massive project to diversify its economy. On the other, it's showing the United States that it won't just follow orders. Crown Prince Mohammed bin Salman has made it clear Saudi Arabia will protect its own interests, even if that clashes with Washington. Then there's Russia. Locked in a bitter standoff with the West over Ukraine, Moscow benefits from higher oil prices that fund its war chest. By aligning with OPEC, Russia strengthens its leverage against Western sanctions and ensures it has a say in setting the price floor. For the United States, this is dangerous territory. High oil prices feed directly into inflation, which is honestly one of the biggest threats to the American economy and politics. Rising gas prices anger voters, squeeze businesses, and can even tip the country toward recession. That's why Washington has tapped into its strategic petroleum reserve to try and calm prices. But those reserves are shrinking and they can't be refilled overnight. Put simply, OPEC's moves are a geopolitical reminder they can turn the dial on America's economy. By raising prices, they increase United States inflation risks. By cutting supply, they test Washington's ability to maintain global leadership. This isn't just economics anymore, it's a chess match. And in this match, every barrel of oil is a piece on the board. When oil prices swing wildly, it's not just governments that feel the impact. Companies, big and small, live or die by how well they can adapt. For independent United States shale drillers, the challenge is, pretty brutal. Drilling new wells costs more every year, and many rely on bank loans or investor funding just to stay afloat. But, in recent years, a shift has taken place. Major banks and funds under pressure from ESG rules, that's environmental, social, and governance standards, are cutting back on fossil fuel financing. That means even if oil prices rise, small producers can still struggle to get the cash they need to drill. On the other hand, the oil majors, companies like ExxonMobil and Chevron, have options. They're still pumping oil, but they're also pouring billions into new technologies like carbon capture, hydrogen, and biofuels. Their strategy is pretty simple. Don't get stuck as just oil companies. Instead, evolve into broad energy giants that can profit no matter which way the market tilts. But there's a catch. Volatility itself is honestly expensive. Investors really don't like uncertainty, and every time OPEC makes a surprise move, it raises doubts about the stability of oil profits. Think of it like a sugar rush. High prices feel good for a moment, but the crash comes fast and long-term health, it suffers. So, while OPEC can jolt the market, the long game comes down to this. Which companies can reinvent themselves, attract steady financing, and survive in a world where oil is slowly losing its monopoly? And this leads us to the next big question. Where do we go from here? What are the possible futures for oil, and which one looks most likely? At this point, we need to step back and look at the bigger picture. Where does all of this actually lead? Analysts often sketch out scenarios to imagine the different ways the energy chessboard could shift. Let's break down 4 of the most realistic ones. Scenario 1. OPEC wins big. If OPEC's cuts hold and prices remain high, the group regains full control of the oil market. U.S. shale weakens because it just can't drill fast enough without cheap financing, and OPEC nations rake in profits. This would really echo the 1970s when OPEC dictated global energy flows and, well, the world had little choice but to follow. Scenario 2, the shale comeback. But shale has a habit of surprising its critics. If American drillers find new efficiencies, say cutting costs with automation or fracking innovations, they could bounce back. Even with fewer wells, smarter wells could keep U.S. oil competitive. In this version, OPEC's shockwave fizzles out as the U.S. regains ground. Scenario 3. Demand collapse. This is the wild card. If electric vehicles and renewables scale faster than expected, global oil demand could peak sooner than the 2030s. Imagine millions of EVs hitting roads worldwide and governments accelerating clean energy laws. In that case, it doesn't matter how much oil OPEC cuts, demand itself vanishes. Oil prices would crash, not from oversupply, but honestly, from lack of buyers. Scenario 4. Permanent volatility. The most likely outcome might be, well, no clear winner at all. Instead, the market lurches between short spikes and deep drops, driven by OPEC, shale, technology, and, geopolitics. Oil never truly stabilizes, leaving both producers and consumers constantly adjusting. Think of it as a never-ending tug of war, with no side strong enough to pull the rope across the line. Each of these paths has supporters and skeptics, but whichever one plays out, it's clear the old world of predictable oil dominance is gone. So what should we take from all of this? OPEC's shockwave isn't just about oil prices rising or falling, it's about a shifting balance of power. For decades, the U.S. shale boom gave Washington the confidence that it had broken free from OPEC's grip. But this latest move proves that the old power players aren't going quietly. Saudi Arabia, Russia, and their allies can still send ripples through the global economy with a single decision. At the same time, the U.S. isn't powerless. Shale may be under pressure, but American innovation has a history of rewriting the rules. And beyond that, the future isn't only about drilling. It's about who leads in new energy technologies, batteries, hydrogen, solar, nuclear, and beyond. The real story is this. Oil is still king today, but its throne is less stable than ever. OPEC's gamble might buy them time and money, but the world is clearly moving toward alternatives. Every shock like this only pushes countries to speed up the shift away from fossil fuels because no one wants to be held hostage by price swings forever. So did OPEC just crush America's oil power? Not exactly. What they've done is remind the world that the fight for energy dominance is far from over. And the winner may not be decided by oil at all.